So today, the plan would be that I would provide some insights into the WEO forecast that came out in January. And then I will present a topical policy challenge, which is linked to the ways to provide corporate support to struggling firms during the pandemic. In terms of what is the outlook for GDP growth, certainly recent vaccine approvals have raised hopes that the pandemic will soon be behind us. However, at the same time, we have experienced new waves and variants of the virus, which pose some challenges for the outlook. So the global economy is projected to grow at about 5.5% of GDP in 2021, and then to 4.2% in 2022. So this forecast that was approved in January actually was revised upwards from the October forecast, and this reflects the expectations of the country desks in the IMF about the additional policy support in especially large economies, as well as the vaccination hopes. So here we highlight in the middle of the chart the Spain forecast, which is that the economy is estimated to have contracted by 11.1% in 2020, but then that will be followed by a recovery of around 5.9% in 2021. So then in terms of the divergence, so the IMF has been a bit concerned about potential divergence across countries because of the pandemic. So this is what we try to show in this chart. So this divergence in growth because of the COVID-19 outbreak so is related to the differential access to medical interventions across countries, as well as to the effectiveness of policy support and the exposure of different countries to global shocks. So here in this chart, what we show is the trajectory of real GDP over 2020 through 2022. And this is the solid line across major groups of countries. And we show this trajectory against the pre-crisis levels, which are shown in the dotted line. And what we observe is that in advanced economies, the level of GDP would have contracted by around 2.5% by 2021. And this is relative to pre-crisis levels. However, in emerging and developing countries, so this contraction will be more severe at around 5.9% relative to pre-COVID levels. So this, we consider this divergence as a measure of scarring, which is a potential long-term effects of the pandemic due to the crisis. So then if now we are going to focus on Europe. So there, what we see is that there was a rebound in the third quarter of last year, and this exceeded our expectations significantly. And so therefore, the forecast for 2020 as well as, for 2020 was revised upwards. So for Europe now as a region, so what we estimated is that the activity will have contracted by around 6% in 2020. But at the same time, this will be followed by a recovery at around 4.1%. So then in terms of the impact of COVID shock on the real economy, so what we know is that infections surged in late 2020, and that is true across different countries in Europe, including emerging countries that were a bit spared during the first wave, but then started to converge in terms of infections to advanced Europe throughout the second and third wave. When we look at data from the last quarter, 2020, what we observe is that the economy seems to be more resilient to lockdowns than in the spring, as people and the economy have adapted to the virus. And this is reflected in this left-hand side chart, where we observe that the curve that shows the sensitivity of real GDP growth to the stringency of lockdowns have shifted upwards for all the countries. So although there is a bit more resilience, but at the same time, the GDP growth projection for 2021 has been revised downward by 0.6 percentage points relative to the October forecast. And this reflects, of course, still the widespread lockdowns that we observed in winter. But still, if we look at the output level at the end of 2021, so we had yeah, some good surprises in 2020, a little bit more reduced growth in 2021, but in terms of the output level, still our projections currently are better than in October 2020. And then what we are seeing that, of course, in terms of when we move forward, so our country desks in the IMF are working very hard to try to incorporate the effect of vaccines in their economic forecast. So what we have observed in all countries is that certainly there are some inevitable problems, in the production and rollout of the vaccines. But this is a key concern, particularly in some emerging economies. And here what we show is the percent of the population that is covered by vaccine contracts across different regions in Europe. And what we see is that, while vaccination in some non-European Union countries, so more emerging markets in Europe, is progressing quite fast and is kind of catching up with advanced Europe. But the vaccine supplies are really like a main concern in some of the emerging non-European Union countries on average. And we observe this as the blue bar, which is quite low. So only like around 40% of the population could be potentially covered by vaccine contracts currently. So therefore, and this is one of the main priorities now for the IMF, is to secure and to accelerate not only the distribution and rollout of vaccines, but also the production of vaccines. Okay, so then now the second part of the presentation then will be trying to look into a policy challenge that we are confronting in all countries in the world, but particularly also in Europe, which is linked to the need to provide support to struggling firms during the pandemic. So here what we're going to show is a study that we just published last week as a IMF working paper. And here in this study, we try to address three main questions. So the first question is, what has been the impact of COVID-19 on corporate liquidity and solvency in Europe in 2020? The second question is, what has been the effectiveness of policy support in ensuring that, on the one hand, sufficient liquidity remains available to firms, but also that the disruptions that we have seen from COVID-19 do not undermine their viability further. And finally, what we try to see is what are the remaining pockets of vulnerability after accounting for the policy support already deployed. So to quantify the impact of policy measures on firms, so we assess over 4 million firms in Europe, covering 26 countries. And also we construct a very granular database of policy interventions in each country. So then once we have the two databases, what we do is to map individual corporate policy relief measures to forecast firms' financial balance sheets and P&L, to try to come up with some financial ratio of vulnerability. So as we know, this COVID-19 crisis has been very idiosyncratic. So therefore, instead of using kind of econometric techniques, so what we do is that we use a structural approach, which is based on simulations. And in our approach, we need to define what are the triggers for corporate illiquidity or insolvency. So we assume that a company is illiquid if its cash position is lower than zero, and a company is insolvent if the book value of equity is lower than zero. So we know that these two thresholds are not automatic triggers of insolvency proceedings of firms, but there's a lot of literature and also under many national insolvency regimes, what we observe is that these two triggers, when they are breached, they actually signal financial distress and increase the likelihood of bankruptcies. So here, what we do then is, here we show our simulation strategy. So we simulate the impact of COVID-19 on firms in 4 stages. So we start from the left-hand side of the chart, in which we collect balance sheets of pre-COVID of all the firms, that is stage 0. And then we calibrate the COVID shock. So we know that the COVID shock has affected firms very differently depending on the economic sector, and depending also on the country because of different containment measures. So what we do is that for each of the 26 countries, we calibrate the economic shock as at the 2-digit NACE sectoral level, which has differentiated shocks across 70 sectors in the economy. And then we kind of scale down all the shocks so that on aggregate, we match the WIO GDP projections. So then we move to stage 1, in which firms are hit by the shock. And there, the effect of the shock on firms depends on 3 alternative credit scenarios, which depend on the firm's ability to roll over its material liabilities. So in our central scenario, before policies, we assume that firms cannot roll over bank debts due to an initial freeze of bank credit. So that is what we would have expected in mid-March before the policies were implemented. Then we move to stage 2, in which we model the effect of policy support. But here at this stage, we include all the programs that alleviate the firm, excluding credit programs. And the reason is that we really want to look at them carefully because they increase the liability amount of the firm. So then in stage 3, what we do is that we add these guaranteed loans, as well as in some countries, there are also direct official loans, and also individual equity injections to struggling firms. And then finally, in stage 4, what we do is that we look at firms that are still illiquid after all this policy support, and then we allow these stressed firms to access external funding, which is non-guaranteed, and which includes non-guaranteed bank loans, as well as bond issuance for large firms. So then in terms of the data coverage, so we include, as we mentioned, all the European countries that have a reasonable coverage in Orbis, which is our firm database. And these countries, which are 26 countries, including 17 advanced economies, which are listed on the table, as well as non-emerging economies, they represent around 90% of GDP in Europe. And the aggregate turnover of these firms in our data sample accounts for 26 trillion euros. So we see, for example, for Spain, we covered around 200,000 firms. And so in terms of the number of firms in the database, so 99% are SMEs. However, in terms of turnover, they cover only around 1/5 of the aggregate turnover. So the other 4/5 are covered by large firms. So then in terms of how representative this data sample is in terms of the overall population of firms in the country, this varies strongly across countries, but our sample on aggregate covers around 80% of domestic turnover. So that's reflected on the last column of the chart when we compare the turnover of our database compared to the structural turnover in domestic accounts. And then to make also our results representative, so what we do is that for each firm in each sector, we reweigh all the results by the national sectoral shares of turnover to address any potential bias in the construction of the sample. So then here we spent quite a lot of time to try to model the wide range of policies that were deployed in most of the countries in Europe to provide relief to firms. So there, the policies that we try to incorporate, there are of two kinds. So one, what we call main policy measures, and these ones include wage subsidies, grants, debt moratorium, and guarantees. And then we also include other policy measures, which include tax deferrals, tax rebates, equity injections, subsidized rates, and changes to policy rates. So before we model the effectiveness of policies, here what we try to measure is the policy intensity for the main policy measures. And this policy intensity combines information for each policy regarding the size of the budgetary envelope, the duration of the measure, as well as the coverage of firms. And this is in relative to peer countries. So for example, if we look, for example, so Spain, so it has had based, quite a strong intervention in terms of guarantees and wage subsidies, but not so much in terms of grants, and also debt moratorium. As we know, the debt moratorium in Spain was mainly driven to households to cover mortgage loans rather than corporate loans, which, for example, that contrasts with Portugal, in which one of the main measures was debt moratoria for corporates. So then once we have the policy, so when we want to model the channels through which these policy measures can help firms. So we distinguish different channels. Acknowledging that some policies support both solvency and liquidity, and that is the case of wage subsidies or grants, whereas other policies improve liquidity but do not have a direct impact on equity, for example, debt moratoria or tax deferrals. And there are some other policies which alleviate liquidity pressures, but at the risk of increasing solvency risk going forward. And this is all guarantees and loans and repayable advances. So therefore, and we will see the results just in a minute, we expect a different marginal impact of each type of policy on corporate liquidity and solvency. So a very big theme when we think about the effectiveness of policies is how to allocate the budget of each measure at the firm level. And as we know, some of these big envelopes were announced. However, the take-up or the actual disbursement of the package has been quite limited in many countries. And that's particularly the case of big guarantee programs, for example, in Germany. So there has been just like 10% of take-up of the guaranteed envelope. So what we do then is that in our simulation, what we do is that we assume that if a firm is eligible to access one program, so we'll try to take maximum advantage of that program. But this is subject to the very strict conditionality, which is linked to the program. And this conditionality relates not only to the type of beneficiary, so whether it's a small firm or large firm, but also depending on the economic sector where the firm is operating, as well as the turnover loss that the firm has experienced or the financial position of the firm pre-COVID. And also in most of the programs, there is a maximum nominal amount of allocation per firm. So once we apply on this conditionality, which is embedded into the programs, the implied take-up rate of the programs in our simulations is typically lower than 100%. And for example, across all countries, the guarantee program is only taken up around 45% on average. We know, for example, for Spain, it was highly successful, so it was around like almost 100%, but on average, the take-up rate was quite low. So then now we move to the results. So due to the COVID outbreak, so some firms would face a very large liquidity shock in the absence of policy response. And this is what we are going to show in the left chart. So this left chart shows the marginal impacts of each policy on the ability of firms to fill the liquidity gap. So in the absence of policies, the rise in the liquidity shortfall as a percent of GDP would have been quite significant, reaching over 7% in advanced Europe on average, and 10% in emerging Europe. So in terms of the marginal impact of programs, we find that wage subsidies tend to have a larger impact in absorbing the liquidity gap than tax policies and grants. And on the other hand, debt moratoria in red and guarantees in green, they seem to be quite effective, particularly for advanced Europe. So overall, policy measures in advanced Europe would reduce the rise in the liquidity shortfall by 4/5. But this absorption would be smaller in emerging Europe. So the policies will cover only 2/5 of the rise in the liquidity gap. So if we think now about the impact then of COVID in the share of illiquid firms, so this is what we are going to show on the right-hand side. In our simulation, the starting position of the share of illiquid firms before COVID was around 11% in both advanced and emerging Europe. and then it would have risen to around 50% without policy measures, and then declined to 17% in advanced Europe after accounting for policy measures, and 34% in emerging Europe with policy measures. So overall, the liquidity policies were quite successful, as we have seen. However, the capacity of these policies varies widely across types of firms, so large or SMEs, as well as across economic sectors. So the left chart shows the effectiveness of policies by type of firm. So if we look at SMEs, which is the second bar, so the chart shows that policies could mitigate only half of the rise in the aggregate liquidity shortfall. So this is partly due to the fact that these conditions, which are laid out in some of the schemes, were quite restrictive, particularly for SMEs. And also SMEs tend to be concentrated in hard-hit sectors, such as, for example, retail trade. So we move now to the right chart. So here what we show the rise and the absorption of liquidity gaps across different sectors. So here what we see is that these shortfalls are concentrated in the wholesale and retail trade sector, as well as manufacturing. So then now we move to equity. And what we find is that the policies, they seem to be less effective in addressing equity shortfalls. So in the absence of policies, the rise in the equity shortfall is around 2% of GDP across countries. So here, wage subsidies are by far the most effective policy to compensate firms for COVID-related losses. Other programs are really not so effective. So overall, policy measures could reduce the rise in the equity shortfall only by 1/3 in advanced Europe and by 1/4 in emerging Europe. So this is not surprising because many of the announced policy measures were designed to address liquidity needs, for example, this debt moratoria or guaranteed credit, rather than solvency concerns. But of course, as the pandemic became more protracted, so then there was a further erosion in the equity position of firms. So in terms of the share of insolvent firms, so again, our results show that the share of insolvent firms would increase from around 3% in advanced Europe and 6% in emerging Europe to around between 12 and 17% before policies. And after policies, it would reach around 8% in advanced Europe and 13% in emerging Europe. So this means that even when we account for policy measures, so the increase would be around 6 percentage points of insolvent firms. And again, we observe a very differentiated impact across types of firms. So SMEs being more hit and across some of the sectors. So here we draw attention to also accommodation and food services, which show very large equity gaps. So then the final result is that certainly a key element in the policy debate is targeting. So is whether policies are actually supporting firms that were not in financial difficulty pre-COVID, but became stressed because of COVID. So here we focus attention now on just a pool of firms that were sound pre-COVID. And what we show in the left chart is that among these healthy firms pre-COVID, around 8% of those firms would become insolvent, even accounting for all policy measures. And then what does it mean in terms of aggregate outlook for Europe? So our findings suggest that almost 3 million firms in Europe would become insolvent because of COVID, even after the policy response that was deployed. And also around 15 million of jobs are at risk because they are in firms which are at risk of insolvency. And then in terms of the calibration of the equity support that is needed to fill this capital gap, so we estimate that across Europe, so the needs would be around 2 or 3% of GDP with a great variation across countries. And then here on the right chart, we show that the leverage ratio for highly leveraged firms, which is at the 75th of the distribution, has also increased once we account for the policy response and also external funding, which is the gray bar in the chart. So then just let me conclude with some takeaways. So our results suggest that government policies have avoided a much worse downturn. Otherwise, the insolvency rate would have doubled. However, policies were more successful in addressing insolvencies than, in addressing liquidity shortages than equity needs. So without additional equity support, some 15 million jobs are at risk in Europe. And then in terms of policy recommendations, so we argue that lifelines should be maintained, of course, while lockdowns persist in this uncertain outlook. But policies need to gradually refocus and provide more equity support to strengthen firms' capital structure. However, this task will be challenging because of the COVID structural shifts in the economy, as well as the complexities to really target policies to identify viable firms in a post-COVID world, and also the sheer number of SMEs that will need some equity support. So thank you. So very happy to take some questions and to speak with Antonio.
So thank you so much, Laura, for your fascinating presentation about the current challenges that we're going through in Europe regarding the effects of COVID on firms. I think it's very clear that many firms have been suffering the lack of liquidity and they're having solvency problems. So let me ask you. One of the takeaways of your paper, your very nice paper, by the way, again, congratulations. I think it's very illuminating. But one of the takeaways is that many firms need some kind of equity support to survive. And I think you mentioned 3 million in your sample size, which was, I think, 26 countries. And out of that, 100,000 in Spain, for instance, are at risk right now. So what kind of policy support at this juncture you think would be feasible to save these firms?
Yeah, so thanks so much, Antonio, for this very important question. So this is something we're struggling now at the IMF, actually, and we are very much communicating across country teams, and particularly we are engaging with the Spanish IMF team very closely. We are having conversations this week, actually. So here, so we are still forming our thoughts because it's very complex, as you said. But what we are really advocating is for more equity support. So the equity support, as we know, can take form in terms of grants, so kind of non-repayable subsidies. But at the same, and this could be probably that could be like a feasible option, especially for self-employed or for micro firms. For other SMEs and large firms, so we see the need of enhancing the share equity of the firms. And there are different ways that we are considering right now. So we know that there are some market externalities, given the big uncertainty of COVID-19, that may prevent private equity to flow into these firms, even if they become viable. So there's room for government intervention, and the government intervention could take place as a direct equity support, and this is what we have observed in some programs, particularly in the European Union. This has been also facilitated by the changes to the state aid framework of the European Commission that allows for recap programs with particular provisions, to avoid market distortion, and also to give incentives for the government for an early exit once the recovery is firm underway. But we are seeing some innovative also equity programs, for example, in France and in Italy recently, in which the government tries to leverage also private banks or commercial banks or private investors. So the case, for example, of Italy, so what they try is that the government tries to provide tax incentives to investors that purchase share equity in SMEs. And also the tax credit for investors, and also which is parallel with the tax subsidy to the firm, so it's capped by the amount of fresh equity which is injected. And similar, and then, for example, in France, what we observe is that there is more like participatory loans that are intermediated by the banking sector.
Okay, thank you very much. So it seems that the government can become, some sort of an entrepreneur in some firms, at least, if they provide this equity support. But I think these alternative channels are very interesting too, and very important at this time. I think takeaway of your paper is that there's still a lot to be done from the policy perspective, I think. And what are the kind of policy priorities at the fund now for Europe?
Yeah, so thanks for the question. So in terms of the priorities, so as we said, one priority is that just want to repeat is to continue maintaining policy support. So until the recovery really is entrenched, because we have seen different waves and there's still a lot of uncertainty. So we want the government to continue bridging economies throughout this through this pandemic until herd immunity is achieved. And then in terms, for example, of the fiscal response that we have observed so far and that we're advocating further, we have seen that in advanced Europe, the fiscal support in terms of discretionary policy, fiscal, as well as automatic stabilizers have reached like around 8% of GDP. And emerging Europe is around 6% of GDP. So we see still the need to continue the fiscal support. But then at the same time, what we discuss is that as the recovery becomes entrenched, so then we need policies to help the transition of workers from sectors that may have to downsize in the post-COVID world, maybe to move to other sectors that may be expanding. So the role for active labor market policies is really crucial, and actually the IMF will publish the WIO in April, mid-April, and there will be 2 chapters of the WIO, analytical chapters, which talk about the relocation of workers across firms. But then something which is important is that a priority for Europe also is to really step up the production of vaccines so that we can actually have a more clear perspective.
Very good. There are some questions from the participants already. There are professionals, there are students. Very interesting questions. One of them is asking whether, I guess, advanced countries have an advantage with respect to emerging ones. How could you kind of highlight this difference, and what are the challenges of emerging economies right now?
Yes, so thanks for the question. Yes, so certainly that's what we are seeing, and actually that has been one of the main concerns of the IMF, which is that we observe a kind of increased divergence between advanced and emerging and developing countries because of the pandemic. So before the pandemic, so let's say, January last year, so there was like some of these economies were catching up, and we know particularly in Europe also there is a mechanism to catch up. And we observe now that there is a little bit more of divergence, and we, I think, observed that in one of the charts at the beginning. So here, as we know, so for example, in Europe, so there is the Next Generation EU Fund that is now being rolled out, and I think the European Commission is assessing now the national plans in April, and once they're assessed, they can be implemented and disbursed. And this allocation will try to provide financial support for some of these emerging countries. But then even within the set of emerging countries, so there is a difference in terms of the fiscal support they can provide to their households and jobs and employers because of the fiscal space. So for example, like right now I'm personally involved in Slovakia, in the surveillance of the Slovakia economy. And there, for example, we observe that the fiscal support that has been disbursed maybe is not as big as in other advanced countries, but they do have more firepower that they are ready to deploy now in 2021. Yeah. Okay.
There's some question here also from the audience about, Nadalaya is asking about vaccine production and distribution. What else could countries do right now to speed up the process of vaccine production and distribution? And how can this be done, in emerging economies too? It seems like very challenging right now, but it seems like, like you said, Laura, vaccines speeding the vaccine is really key at this juncture.
Yes, so that's right. So this is a very hard question, and I'm afraid I'm not a specialist on vaccine production. But what we know, however, is that I think there are like around 10 vaccines now. So what we need is, first of all, to expand the contract with firms that have approved vaccines. I think there are like 10 vaccines approved now. And then in terms of production, so I think there's some discussion which is thinking about providing incentives to pharmaceutical firms, because one of the problems that I understand is not only is that the massive production of vaccines requires a lot of investment in terms of logistics, which may not be used, in a medium term. So it's an investment that is difficult to then continue utilizing. So that maybe limits a bit incentives for mass production, apart from logistical issues. So to provide more direct incentives to pharmaceutical firms, that would increase the production. And then we also look at, for example, the case of Israel, and actually in the IMF, we invited the Minister of Health, of Israel to try to understand a bit what are the logistical, recommendations to secure this production and distribution.
Okay, let's turn now to low-income countries, and I think they're all in our thoughts right now, because if we're suffering here, no wonder. I mean that low-income countries are suffering a lot, are having a very tough time. So, what has been the approach of the IMF to help these countries at this important time during this crisis?
Yeah, so no, this is so this has been a priority to support low-income countries. I mean, all our membership, but particularly low-income countries. So just maybe as background, just to say that the IMF, has a big lending facility, which is around $1 trillion US dollars that can lend to membership. So out of this 1 trillion, so we have lent around 286 billion, so around 25%. And then out of that, 100 billion has been lent since the start of the COVID pandemic. And this 100 billion has covered around 85 countries out of the 190 of the membership. And this includes 52 countries, which are low-income countries. And then, so I will just maybe mention that from this 100 billion, so of course the IMF has different programs depending on the needs of the country, and also the their capacity also to face fiscal stress. So there have been like 32 billion. So 1/3 of this 100 has gone in a facility which is called rapid facility, which means that it doesn't have conditionality, is fast disbursing, and then out of these 32 billion that I said 1/3, so 11, so 1/3 of the 1/3, sorry, 11 billion has gone to low-income countries. But then apart from that, so this is like the general resource account of the IMF. But then in addition to that, we do also have, we provide debt relief to countries, to low-income countries. And this is another, this is through a trust also with donors from member countries. It's called the Catastrophe Containment Fund. And then there, so there has been like suspension of payments from eligible countries, low-income countries, until at least April 2021. And then in addition to that, I would say that these lending programs have been supported by extensive capacity development that we call, which means training to officials, also to kind of support the recovery, as well as providing also technical assistance. So to also like enhance, for example, their fiscal frameworks, also the management of all these investments that they have to produce now. So we have, I think we have produced around 1,400 missions to virtual missions, actually, like this, like in a kind of virtual engagement with countries.
So thank you very much, Laura. And I think the reply shows that how useful the IMF is. And besides having extremely competent people working there like you also have a big heart to help, poor countries at this time, which is, a very important thing at this juncture. There's a question that has come up by Alex. I think it's interesting. And I think it links well with what you're saying, that, of course, the fallout of all these policies that are very important to support the economy is probably the increasing debt that's coming out of this. And we're worried in a way that, I mean, we will not produce enough growth in the future to pay back these debts. I mean, this is something that in countries, for instance, areas like Europe that you know well, it's been a concern that, well, there's been growth, but at some points it's been faltering. And the same thing could be said of other countries or emerging economies. What is your perspective on this? And how do you see the future of all this, increasing debt that has been used to finance the COVID efforts?
Yeah, so thanks so much again for the question, because this is a crucial question and a major concern is also in the IMF. So I will say first, of course, all these are very timely issues that we are still rethinking, and we try to adapt also our policy recommendations to each country. So, but overall, let me say that first, as you said, there is a big concern because public debt has increased. So on average across the world, if we think about, if we project the pre-COVID public debt over GDP, if we project that to the end of the year, so it would have been around 84%, which is already quite large on average, 84%. But now under COVID is around 98%. So it has increased 15 percentage points, which is quite substantial. And this is across the world, but of course, some countries, they have deployed more fiscal impulse, as we said. So then here our advice is, in general, the policy recommendation is that we really have to continue the fiscal support. And this is the priority. And actually many countries, and we have also already maybe hinted in the presentation, some countries, they could do more. So they should really look at their fiscal envelopes and also the take-up of these programs, and then see whether they actually need to expand more. And I mentioned before the case of Slovakia, but many other countries. So they have to rethink whether to spend more. At the same time, as you very well said, so there's a concern on the sustainability in the medium term. So countries already now, what we are recommending to the countries is that they need to really, to have already like medium-term, projections that ensure debt sustainability. So they do not implement yet the debt sustainability, but they have the framework in place. So once the recovery is really underway, is entrenched, so then they can start fiscal consolidation, but it has to be very gradual, and also is going to prioritize, some schemes also that may, for example, so that may increase investment. Because what we saw, for example, after the financial crisis, is that the fiscal consolidation after the response in 2009 has been especially reduced investment. So here, the advice is to actually increase investment, and this could be not only direct public investment, but also provide incentives for private investment. That's the new line that we are now discussing. But then, of course, there are some countries, that have unsustainable debt burdens, and this, and here we should really address that quickly, and we are, discussing with member countries about different ways to actually restructure debt.
Very good, very good. So here's a question that here in Spain has been asked a lot about conditionality on the relief efforts by the IMF, or here in Europe, for instance, with the Next Generation Fund. It seems that there's a number of conditions that are going to be attached to releasing those funds. What is your, let's say, strategy, or from the IMF? Do you condition the release of these funds, or do you monitor? You ask for transparency, you ask for programs of these countries to release the funds, or?
Yes, thanks. Yes, so I would say, so let me maybe address the question in two ways. So one is there are some lending, some disbursement from the IMF to the member countries that I mentioned earlier. And there, as we said, because of the pandemic, there was this rapid credit facility that accounted for 1/3 of the whole disbursement that has no attached conditionality. So that's right. So of course, there is also extension of current programs, which are certainly attached to conditionality. So it really varies, depending on the program, depending on what is the trigger of the program. If it's macroeconomic imbalances, they will have more conditions attached. If it's kind of catastrophe relief, like COVID related, so it would be more rapid without so much conditionality. So this is for the IMF lending programs. If we move now to the European Union, so as you said, so the Next Generation EU fund, so there are some targets that the European Commission thinks that they should be met, and some of these targets relate to the objective to reach the twin transition, so the low carbon economy as well as the digital economy. So this is something that we in the fund, our line is to incentive, to encourage countries to really move to a more resilient post-COVID economy. So we also can echo these kind of transition goals. But as I said, we are not. This is not IMF program, so we are not really monitoring, the conditionality attached.
Okay, let me maybe ask a last question precisely on the future sustainability of our economies. This is a big issue that we are very concerned throughout the world, and indeed, all this post-COVID world can be one where, all the new incentives and policies can go in the direction of greening the economy and making a more sustainable economy. This is concern we'll have, but in a way, it's an opportunity we have at this time to support this kind of recovery. How do you see it, and what do you think are the main challenges right now, and what do you think we could do, to go in this direction?
Mm-hmm. Yes. So thanks for the question. So again, this is a big priority for the IMF and for, of course, the countries. We reflect the membership's priorities. And the idea is that, as you said, so if we help with, if countries can build some climate resilience, so that's going to promote not only low carbon development, but also can support economic growth and also employment and inclusiveness. Yeah. So here, so the IMF has been kind of recommending, some mitigation policies to support the recovery. So from the COVID-19 into this more resilient economy. And there, in terms of the how to green the recovery, let's say, so there some of the policies include to have some kind of pre-announced progressive increases in carbon pricing, but that has to be accompanied also with some other mitigating instruments. For example, like what they call it rebates, which is like some fees and some rebates, for different types of utilization, depending on their impact on climate change. But also very importantly, is to support investment, as we said, in green infrastructure and also climate adaptation policies. So for vulnerable countries, and I'm thinking about, there are some kind of low-income countries which are very much prone to climate risk. For example, Bangladesh, Pakistan, and so forth. And also there are many other countries, even in Europe, that are subject to floods. So there. So what we are recommending is to integrate what we call disaster risk into their fiscal framework. Yeah, so to incorporate that. Also, we are helping them to try to stress, their financial system against climate risk, not only, as we said, not only transition risk, as we discussed before, but also physical risks, and incorporate that also in the macro financial forecast. And but then, very importantly, what we stress is that it's critical that the transition towards this carbon neutrality, so that it's fair for everybody, so that we need to really support, the workers, to transition, in carbon intensive industries, right. And also protect households against increase of carbon prices.
Yeah, the transition is very challenging and very, right, you cannot go from carbon intensive economy to fully green in 1 year. It takes time. Well, I was going to finish, but there's two hands raised. I guess quickly we could address those questions. I don't know if Neil, you would like to make a question, or Gilbert?
Yeah, thank you. Thank you, Antonio, and for putting together the presentation. I just wanted to mention, the big point of this study seems to be that there's more of a gap in this solvency than in the GDP. And first of all, the benchmark seems to be what was going on before the crisis. And so one point I'd like to make is I'm not sure we should expect to go back to where we were before the crisis, or at least, immediately. It's an enormous shock to the system, and we have to accept that. And we shouldn't try to build back everything to where we were before. And as was mentioned, it's very costly to impose this kind of debt on society. But as far as the solvency goes, I find that to be a little bit of a less concern than the other, and that is because of restructuring. In other words, there could be mergers, there could be takeovers, are changes that are going to occur in the economy. And, in the US, where I am, we got Amazon.com has taken over a lot of the business that was formerly done by, regular retail shops and that type of thing. We have to accept that's changing, where we've got a Zoom call now, whereas before I'm sure it would have been in person. And so we have to accept those kind of changes that come out of this. And, we shouldn't try to have an objective to redeposit all the equity back in the owners, because the ownership is going to take different forms, I think. And so that's why I say I'm a little bit less concerned than it sounded like you were with respect to the so-called bigger gap in the solvency.
Yes, so thank you very much, Neil. So yeah, for the great question. Yes, so yes, that's right. So it's something that I don't mention, and I completely agree. That some firms, may, as you said, may be acquired by other firms, or they may have to exit the market. But so here, I guess that our main concern is, to try to kind of smooth the transition. So either M&A or through exit. And here, as you said, one of the aspects that we also advocate is for firms that really they need to restructure. So to kind of apply some preventive restructuring methods. So, for example, in the context of Europe, so there is the European Union Directive on preventive restructuring mechanisms, particularly for SMEs, which need to be enhanced and transposed. And also, if particularly out of court restructurings, but also some of the insolvency regimes for firms that may need to be liquidated, so they need to be also enhanced. Yes, so the objective here would be to, in any way, to kind of prevent, excessive or massive bankruptcies and job losses. So certainly, if there is like some firms that can acquire, the small firms, retail trades, as you mentioned, in the US, so that as long as it helps, it protects, workers, so that is a very feasible solution.
Okay. So thank you very much, Neil. I'm very happy that this was the last question by a professor of the Master of Economics and Finance that is sponsoring this event. And thank you so much, Laura, for your presentation and your gracious answers to every question, as you always do. I think it's been a great time. We've learned a lot, and we've seen that there have been a lot of challenges over the last year, but economically speaking, the next year is going to be it's going to be challenging, it's going to be difficult, but we also see that there is hope, that there are some good policies having some effects. Probably we will not save all the firms, also going in line with Neil's comments, but I guess we can save, some of the productive capacity of our countries, and we can save kind of precious jobs at these difficult times. I don't know, you want to make some final comments, Laura, or?
Well, just to mention that it has been a great pleasure, and I very much thank you for the opportunity to participate in this event, and also to have this engagement also with the audience. And it has been, a privilege to discuss with you, and I'm very happy to collaborate further in further events. Thank you so much.
Thank you so much, Laura. Thank you very much to all of you, who participated in this event. We'll invite you for future events. I think this was very enjoyable. We all learned a lot. Thanks so much to everyone. Thank you.
Thank you all.
Bye now.